Wilmington Trust this morning said, I think we can officially now call this the death of the Phillips curve. Can we say that?
I think that's a bit strong. I think clearly they're downgrading that relationship. I mean, I think if you asked most of them, they would still say there's probably a relationship. There's certainly a statistical relationship between very tight labor markets and inflation. But I think with that change in the formulation of employment, how employment or deviations from their estimate of full employment influence monetary policy, they're going to be less preemptive. They're much less likely to say inflation is likely to come, rise strongly in the future just because the labor market is strong, and that's a reason to hike. So that has definitely been changed, and I think that is an important change. I wouldn't call it the death of the Phillips curve in their thinking, though.
Right. He did say that any overshoots were likely to be modest, but what do you think happens the first time we get a legitimate spike in inflation? How is the Fed going to have the fortitude to stick by this strategy? And what are all the rest of us going to do in terms of those who normally worry about inflation spikes?
Well, I think it depends on the extent of the spike. I mean, if we're talking 2.25% for core PCE inflation, or even 2.5% for core PCE inflation, I think that's very consistent with this, moderate overshoot story. If we're talking 3% or more, I think that would be concerning even to this Fed. So when they're saying moderate, I think they mean, half a percentage point. I don't think they mean